So hello and welcome to the latest video which explores the Woodruff financial planning model investment portfolios. We produce this every 3 months as we update our model investment portfolios, and the idea is really to give you a flavour as to how they work in practice, show the differences between the various options that we have, and also to give you an idea of how different portfolios react at different stages of the investment cycle between investing from a cautious through to an adventurous way of investing your money. So I just want to give you just a sort of overview as to how we use model investment portfolios in our financial advisory practice. What we have is a series of risk-based investment choices, and we use these for new investments, but also to review existing clients. When we come to your annual review, we're going to review your portfolio against the ideal portfolio that we can find for you, given the risk that you want to take. So we're going to have a conversation with you around risk, how much risk you want to take, how much risk you need to take, and then we can use that as sort of ammunition to compare the two and then make the investment decisions. So if you come on board as a new client, you're going to go straight into one of our model investment portfolios, assuming you haven't got any other sort of specific needs that we would need to cater for. And clearly we can go off piste if we need to. So what I should say is this information is based on past performance, is based on the actual performance of our model portfolios, but your portfolio won't be the same as one of these, because we will make different changes according to your own individual needs. You'll invest on different dates to how this were invested, and there may be a whole range of other issues that have an impact on this. So really I want you to take this with a pinch of salt, because what we're trying to do is give you just a flavour as to how the different portfolios work, but bear in mind the actual performance will vary significantly based on your own individual circumstances, the investment timing, your own tax situation, and the charges of the investments that we put you into. So please don't take it as read that if you go into one of these portfolios you're going to get exactly this level of return, because with most things with investment we can't guarantee that at all. So what we're showing you here, this is all the data that appears on the same web page where this appears on our website. I'm just going to go through to show you a breakdown as to how the portfolios have performed over the last 5 years. So interestingly, this is coming at a period when the stock market hasn't been doing too well. So we can't always guarantee that the stock market will go up, and in fact we have zero control over it. And all we can do is to spread your money into a diversified portfolio that aims to take the level of risk that you want to get, and knowing that sensible things are going to happen to sensible investors who invest for the long term. So we don't control any of it, and we can see that clearly reflected in the portfolios that you see here. So for example, you can see on the left hand side we've got 5 portfolios. These are the growth portfolios, ranging from cautious through to moderate through to adventurous, and the idea is we would select the portfolio that most represents the risks you're prepared to take. But when we look at your financial plan, we actually want to be looking at some realistic assumptions for growth of these portfolios to examine the risk that you need to take. And actually the risk you need to take is actually more important than the risk you're prepared to take, and we need to have a sensible practical discussion around those two issues. So this data is before charges with income reinvested. So if you look here, we've got the cautious portfolio taking 46 out of 100 risk. So 100 on that scale. If you look at the right hand column, that's the Financial Express risk score. That's our data provider, and they have a score of 100 for the FTSE 100. That's the top 100 companies in the UK. So currently our cautious portfolio is running at 46 score as a relative risk to the overall stock market. And you can see there some interesting things. Over 1 year the stock market was down, but the UK stock market was down by roughly 10-12%. I can't remember off the top of my head, but the cautious investor would be partially invested in that stock market, and therefore they can't avoid going down when the stock market goes down. But in a 1 year period, you can see that the cautious investor has been sheltered quite significantly from the more volatile nature of the stock market. Over longer periods of time, you can see annual returns more reflecting what you would expect from a cautious portfolio. I'll be aiming for 5 to 6% returns before charges for this portfolio. So you can see over 3 years it's generated nearly 6%, and over 5 years it's generated 5% return. So it's within the range of what I would hope to achieve with this kind of portfolio. And you can see there that we've also shown you annualized returns for each of those periods and cumulative returns. So a cumulative return is if I invested 3 years ago to the date of this report, you would have had 18.97% return from day one to 3 years out from that investment. And the annualized return averages that return over a 3-year period or a 5-year period. So you can see as we go down the list, over 1 year we've had bigger losses each year, but over the longer term you've had greater returns on your money in general. So you can see that as we go through. If we look at the adventurous portfolio, unfortunately adventurous investors haven't done particularly well over the last year, but if you look over 3 years and 5 years, they've done a lot better. And in fact, you still would have been showing decent levels of growth, even though in the short term you would have lost some money. And it's quite an important thing to think about, really, because you should expect, on average, if you're investing in the stock market, that typically 3 out of 4 years might go up and 1 year might go down. Now, I can't guarantee that's going to be the case every year, but the general principle is that the general trend should be up. So even though you have to take the odd year or two with negative returns, overall you should expect more positive returns the longer you're prepared to invest. And it's that length of time you invest in the market that should lead to significant returns over cash over time. And generally speaking, the more risk you're prepared to take, the greater return you should expect to get. And this chart kind of bears that out, doesn't it? If you'd have been looking at this chart 12 months ago, the figures would have looked a lot better, and that's because we were on at sort of the crest of a wave with stock markets. And of course, you can't rely on that either. And if you look at that and try and think, well, there's never any downside to investing, well, clearly you can see over the 1 year figures here when times might be less positive in terms of the returns you get, but generally over time you should expect a positive return. If those negative figures, you're looking at those and it gives you palpitations, then in all honesty, investing shouldn't be for you, and putting the money under a mattress or in a bank account is probably the right place for you. So I tend to look at 5 years as a realistic review for these things, and I'll be honest, I would put many of these returns at the bottom range of where I would expect you to be over a typical 5-year return, and that's because we've just come off the back of a negative year, so that has a dampening effect on the overall returns. But you can kind of see how those portfolios work in practice as you go from cautious to adventurous. Generally the returns have been better. There's a bit of a blip between the moderately adventurous and the adventurous. And you can also see there that the risk score does go up through the portfolios. And again, that's deliberate. We want people to get the right level of risk for what they want in their investments. Okay, to put that into practice, how this is some sample figures to give you an idea if you were a cautious, moderate or adventurous investor after our charges and after some sample investment charges. These are the kind of cumulative returns you might have got had you invested 5 years ago in our portfolios. Now, none of this is guaranteed. I've said this a number of times. Your own individual situation will be very different, but it can give you a flavour as to how investing can benefit you positively with some real returns on your money over a decent level of decent period of time. So it gives you an idea as to where you could be had you invested 5 years ago. So just before we finish off, we've used the past performance of the actual models, but there's no guarantee because the past has gone. So your situation is going to be very different, and we have assumed charges in those returns just to give you an idea of the return. So if you were to take the actual raw data and multiply that by a £300,000 investment, you would get quite different figures, because obviously the charges have a dampening effect and on the returns. So if you want to know more about how our investments are put together, we do have an investment philosophy document. You can get to that from this video by clicking on the link below. And it's about 20 pages. It's a quite straightforward guide written for somebody who's never invested before, and it shows you the important themes that you need to understand before you get into investing, and more importantly how we apply those themes to a client's portfolio. So if you work with us, you're going to have that level of discipline applied year in, year out from the beginning, annual reviews, quarterly valuations, and we're going to be regularly applying these kind of philosophies to make sure you stay on target towards your medium to long-term goals. So that's it. Thanks for listening. If you've got any questions, obviously you can contact us using the various forms or phone numbers on the website. But failing that, come back in 3 months' time and you'll see the same video with slightly different data as the situation changes.